Hi, this is Sunny from Pristine. In the last session, we have seen the basic terminologies of the options. We have understood the different payoffs of the options. In this session, we will try to build and understand the trading strategies using options and their payoffs. So before we actually start with the different trading strategies, I would like to give a brief introduction about a few characteristics that would be helpful in understanding and building the strategies. So suppose I have a call option. So there are basically two straight lines. One is parallel to x-axis line, another one is upward sloping line. So here we must understand that whenever we have a call option, the slope of a upward sloping line is 1. So slope of 1 means that if I go in the positive x-axis direction with a change of delta x, we will have a corresponding change on y-axis, which if I say equal to delta y, so here delta y would be equal to delta x. So that's one point. The second point is that the slope of a horizontal line would be 0. Okay, so if I add a line on this payoff, so the resultant payoff would be decided based on the slope of the line added. So suppose I have this call option, and suppose if I add another line which is say parallel to x-axis, that means that the slope of this is also 0. So if I want to see the resultant of these two, so resultant of these two would be somewhat like this. So resultant of these two would be this point would be added to this point. So if this is say 5, this is say 10, the resultant would be 15, right? So this would be 15. So if this is plus, so this would be minus here. So this is also minus here. So this would be minus 15. Now till the point x, the slope of these two lines is 0. So till the point x, we will have a parallel to x-axis line with a slope of 0, right? So here from this point onwards, we have two lines, one with a slope of 1, another with a slope of 0. So if I add these two lines, I will get a upward sloping line. I will get a upward sloping line. So suppose the strike price here was say 100. This is 100. So what would this point be? This point would be, since the resultant slope here is 1, this delta y should be equal to this delta x, correct? So here delta y is equal to 15. So this delta x would be 15. So this particular point would be 115. So 115 would be the break-even point for the resultant payoff of these two individual payoffs. Similarly, we will try to see different strategies based on the resultant payoff of two different instruments, or say multiple instruments. All right, and all those payoffs will have some fancy names, and we need to remember those names. All right, so now we will start with two basic payoffs which are called as covered call and protective put. Let us take an example where you have a stock which is presently trading at $100, and you think that the stock is going to go up only by 10%, which means it can go to 110 and not beyond that. So suppose the present price is $100 and you think that the price can go up to 110, not more than that. But you want to earn more on this, you want to earn a higher return than 10%. So what you can do is, since you are already holding these stocks, or say a stock, what you can do is you can sell a call on that. Sell a call on stock with strike price of 110. So suppose you already have a stock, so the payoff of the stock would be, say, something like this, right? And suppose you have sold a call option, okay, sold a call option with a strike price of 110. So with a strike price of 110, you have sold a call option, so the payoff of the call option would be somewhat like this. Now here the strike price is 110, and here the value of the stock is $100, right? Now, so suppose this is the resultant position now you have, and suppose the value of the call option that you have sold is, say, $3. So you have gained $3. Now if we try to make a resultant payoff of this, we have nothing but two lines. So here, if I divide this complete payoff into two parts, so below 110 I have one line with a slope of 0 and another line with a slope of +1, right? So the resultant here would be a upward going line, and at 110 the resultant would be $3. So this is $3 and this is 100, sorry, this is 100, and here this value would be at 110, this point would be nothing but $10. So the payoff on the stock would be $10. So at stock price of 110, the resultant of short call and the long stock would be 10 plus $3, so it would be $13. So here it would be $13, and here I have an upward going line and a straight line, so I will have a resultant of an upward going line. So this point would be, so since this is 13, this has to be 13, but it's towards the negative x-axis, so this would be 110 minus 13, so this point would be $97, correct? And if you see beyond 110, we have an upward going line, we have a downward going line. So the slope here is +1, here is -1, so the resultant would be a slope of 0. So the resultant of these two payoffs is a short put. So this, if you remember, this is the payoff for short put. Now the thing to note here is that you were expecting 10% return, okay, and you were expecting that the price of the stock is not going to go beyond $110. So if it goes beyond $110 or it stays at $110, you will earn a return of 13% instead of 10%, because you have earned $3 by selling the call. But if the stock goes below 110, okay, goes below 110, you will start making a return of lower than 13. So suppose the stock goes to, say, it remains at, say, 107, so the resultant payoff would be $10, okay, and if it goes to 97, you lose your 10% as well. Okay, and if it goes below 97, you start making a loss instead of making a profit. So this strategy would be valid only when you know that the stock is going to go up, but you think that the stock will not go up beyond a particular limit. So in those cases, when you think that the stock is not going to go beyond a particular limit, to increase your return, you will sell a call on the underlying with a strike price of your extreme limit of the stock price. So here the extreme limit was $110. All right. So this strategy, this resultant strategy, is called as covered call. So covered call, because you are covering your call, you have sold a call option, and you are covering this call using your stock holdings, using your underlying holdings. So if you have sold the call, in other ways, we can think in this fashion that since you have sold the call, so if you have sold the call at the maturity, you need to give the underlying. So since you have to give the underlying at the maturity, you have already bought the underlying at t equal to 0. All right, to hedge that risk, you have already bought the underlying. So that's why it is called as covered call. All right, so here the takeaway is that you should be able to build two payoff diagrams, and using those two payoff diagrams, you should be able to build a resultant payoff. So in the exam, a question can be asked on the basis of the resultant payoffs. So a question may ask you that what is the resultant payoff if the stock price is say 103. Okay, so if the stock price is 103 and you have these two strategies employed in your portfolio, then what is the resultant payoff? So if you are able to build this kind of payoff, you would be able to calculate the stock price. So here, if the stock price is 103, we know at 97 the payoff is 0. So at 103 the payoff would be $6, because 103 minus 97 is 6. So if delta x is 6, I know that the slope is going to be +1, so it has to be $6. Now extending the same example, suppose the investor thinks that the price is going to go below $100. So suppose it goes to $90. It's expected to go to $90, which means a loss of 10%. Now to reduce this loss, the investor can buy a put option with a strike price of $100. Okay, and the strike price of $100. But since we are buying a put option, so here we are buying a put option, we need to pay a upfront premium for this option, and suppose the premium paid is $5. All right, now this problem reduces to the resultant payoff of two instruments. So here I have one instrument which is the stock itself. So it's having a linear payoff. So this is $100, and I am buying a put option with a strike price of $100. So this would be somewhat like this. Now the idea is to find the resultant payoff. So here the premium is $5. This is -5, and so this point would be $95, and here this point would be $5. So here this would be -$5. So here if I have to find the resultant payoff, so resultant payoff at $100 would be -5. So here it would be -5, and below $100 price, I have two lines. One line is going upward, another line is going downward. So the resultant would be a line with a slope of 0, and beyond $100 I have an upward going line and a parallel to x-axis line. So the resultant would be an upward going line with a slope of 1. So this distance is $5. This point is $100. So this point has to be 100 plus $5, which is $105. So the break-even point of the resultant payoff would be 105. This, if you remember, this is equivalent to a call option with a strike price of $100 and the premium of $5, right? So this strategy is called as protective put. So here the put option is protecting the stock, which is going to go below the current price, okay, and the loss expected was $110, right? Now if you see here that when the stock goes to $90 here, the percentage loss is not 10%, but the percentage loss now would be only 5%, correct? So the loss is minus $5, the resultant loss is minus $5 instead of minus $10. So here the loss has decreased from $10 to $5 only. And if the stock price goes beyond 105, the resultant strategy actually starts making a profit, right? It starts making a profit. But in this case, here, if we had a simple naked stock position, the stock would have started making a profit even after $100. But when we undergo into a protective put strategy, the profit does not come beyond $100, but it comes beyond $105. So that is a loss we need to bear for the decrease in the downside loss. All right, so here we have decreased our downside, which is expected, and we have decreased our profits as well. All right, so this strategy is called as protective put. So here we are protecting our stock position using a put option. So that's why it's called as protective put. In the next session, we will discuss a few more strategies that would be slightly complex than these basic strategies. So thanks for listening and stay tuned for the next session.